What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 4th of 2019. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I want to spend some time to focus in on the stock market and try to answer a variety of questions that many of you have had in relation to my views on whether or not I'm actually currently holding any equities, why I'm currently bearish on the market, and what is my outlook over the next coming year in 2020. So I want to spend some time to talk about all of that. We've got a lot of the things to discuss, guys. Let's go ahead and dive right into it right after our quick sponsor. Our sponsor for today's video is eToro. eToro is a trading platform that allows users to access a variety of markets from stocks to cryptocurrencies and is now opened up to US users. If you're just getting started with trading, eToro is a great platform as it gives you $100,000 in virtual money to test out your trading skills when you register on the platform. It's important to know that eToro is a social platform. On the site, you'll be able to view the live portfolios of top traders as well as follow and engage with other traders on the platform. eToro also provides a wide exposure to some of the top cryptocurrency assets. So if you're looking to get started in trading, check out the link in the description. Alrighty, everyone, so let's go ahead and get the video started by answering what I believe is the most simple yet relevant question for many of you out there who are long-term viewers of the channel, and that is whether or not I currently hold any exposure to publicly traded equities. Do I have any stake in the stock market at the moment? And to be quite frank with you guys, as much as it might come as a shocker with how much I talk about the stock market, how I really got my original investing experience over the last 7 to 8 years in equity markets, I currently, at this moment, do not own any publicly traded companies. Period. I don't own anything right now in the sense of the stock market. And I know this might come as a shocker because I do press, long-term thinking. I do press, for example, the idea of diversification into multiple sectors. And I 100% agree. If you guys believe that's the right path for you and you guys want to have exposure to stocks now, I'm not saying sell everything or anything. I'm not going to be pushing that in this video. Diversification is key. But with my risk appetite right now, I'm someone who has always, ever since I've really gotten started, loved to trade the longer term swings. As I've probably pressed, I'm a macro trader. I'm someone who, rides cycles. I swing trade. I don't really just simply invest for the long term. And along with that as well, I also don't speculate on the daily time frame. And it's interesting. A lot of the people who are long-term proponents as well of the equity market and other markets as well are actually doing something very similar. I'm going to be talking about that in this video. So I'm not the only one who's currently waiting for a dip in equities at the moment, who believes that we might be a little bit overvalued at the moment when it comes to US equities and also global equities as well. So let's go ahead and get started on it. Well, I want to explain a little bit of my rationale, and we'll build on that as we go throughout the video, as we start to get a better grasp on things. But there's a lot of clear things right off the bat, guys. Equities are in their longest expansion in U.S. history. We have never seen the stock market between the S&P 500, the NASDAQ, and the Dow Jones ever rally for this long. We've been expanding ever since the lower band of March in 2009. And as we can see here on the daily time frame, it looks like a very long time frame, but if we put it on the weekly here, we can see just how long this rally's been going for. And boy, has it been a really good return if you've been long on the NASDAQ specifically. But I mean, across the indices, it's been the general same trend. But the NASDAQ and tech stocks have been doing amazing. They have been a huge killer over the last few years as technology has continued to mature. We've seen profits come to the technology sector. And again, a lot of this valuation is justified. I want to be the first to say that. Now, taking that into mind, though, a lot of this valuation is also way overtly valued in this case. There's too much exuberance on the market. There have been too many tools being used to prop up equities at the moment. And it's gotten far away from, in my mind, fair value. And I really don't think I'm the only one who believes this. In fact, one of the most admired investors in the world and his company, well, in this case, Warren Buffett and Berkshire Hathaway, is actually sitting on a massive cash pile. There's a lot of other companies as well who are holding big cash piles, but I think a company like Berkshire Hathaway is one that we need to take note of because Berkshire Hathaway has been one of the most successful companies. It's not only one of the largest in the United States in the sense of the assets that it owns, but it's run by Warren Buffett, who is one of the richest people in the world. And when you take a look at billionaires in this world and kind of the leading financial kind of the big players in the world of finance in this case, it's very important not to, again, just look at the kind of tidbits that they put out and stuff, to actually look at what they're doing. And the nice thing is that you get a lot of transparency as to how they're moving money. Berkshire Hathaway, a publicly traded company, has to be transparent on its reporting data. And it actually turns out that it's been a net seller of equities and has slowed its repurchases over the last few quarters. Very interesting change in trend. And this is very much against what Warren has talked about many times, which is this idea of don't worry about the day, don't worry about the price, just keep averaging in. The stock market continues to go up in the long term. It appears right now that Berkshire Hathaway is currently waiting to add in positions at a later date. And who can blame them? It's difficult to buy hundreds of billions of dollars of stock or equity in companies that might be private, right? You can't simply do that. It takes a lot of, sell side pressure to do that. And sometimes you need to wait for a recession to do that, not to mention you really don't want to pay a crazy premium when you know there might be a recession around the corner. And being in the longest economic expansion with things heavily overvalued, tech companies not making a profit that are worth 10, 20, 30, 40 million, might be justified wanting to wait off on that. And you can see here as well, their earnings have dropped in this case as well, which again, we're starting to see a pullback in corporate earnings in this case. Again, they're a mass owner of a lot of different companies, they're a conglomerate. So again, they're seeing the cycle starting to come into play here. Now, if we dive a little bit deeper into the article here, we hear about the fact that they've got this $122 billion cash pile. Despite having a good problem on its hands, Buffett has been struggling to find enough well-priced opportunities to keep the growth up that allowed him to beat broader markets for decades. With Berkshire Hathaway, it's been an absolute outperformer. So as they become a net seller here of stocks and everything, why is it that they're having a hard time finding growth here? Well, the first thing, as we discussed, is that this market is very overextended. I mean, you've seen for the last 2 years, really throughout here in 2019 and 2018, ever since I turned bearish on markets back in 2018, we haven't really moved much higher. Again, guys, you guys can go back. I've uploaded these videos. They're still up on the channel. I started talking negative about stocks back in 2018. And I'll say I was off in the sense of maybe the fact that we've gone up a little bit higher since then and we haven't had a correction as early as I thought. The Fed has found many ways to extend the market expansion. But the thing is, we aren't really that much off from where the market has topped out as of recent. We were kind of getting bullish in the upper 7,000 point range here for the NASDAQ. And this has been where there's been increased volatility, increased uncertainty, and really not a lot of buyers coming into the market. Really a lot of things like stock buybacks and these kind of cheap mechanisms that keep stock valuations higher and aren't really sustainable measures to increase the expansion over the long term. So these were the things that kind of got me concerned. I was concerned at the fact that companies were overextended and they were being overextended by mechanisms that weren't really organic, that weren't really fueling an uptrend as we've seen in the past. Now, speaking to this point about Buffett's kind of cash pile and everything, I think Buffett, as much as any other investor, is concerned about what's going on right now. And this is this tug of war we talked about the other day in the sense of the current administration, in the sense of tariffs and the trade war, as well as the current management of monetary policy. Probably the two most relevant factors in the sense of the economy right now. And I want to better explain this. Someone left a comment the other day on my channel, and as you guys know, I try to read all the comments I can, try to answer as many questions as I can and explain it. I think I did a better job explaining it in the comment to him as to something I referenced in this video, this tug of war between Trump and Jay Powell right now. And this isn't really political, guys. This is just kind of what's going on right now, at least from what we can tell. And that is that, for example, we had one rate cut the other week ago, just this last week in the end of July, that lowered interest rates. And the Federal Reserve, who cut the interest rates, decided this is going to be a one and done kind of thing, that we're not going to be cutting multiple rates multiple times this year, which was counter to what a lot of people were expecting. And that's exactly the kind of reaction we saw in the stock market. We actually saw a pretty big dip over the last 2 days of the week here as we started to go down on pretty much every single indice. So the market had that priced in, and Trump as well wants to see, just like any other president who doesn't want to have a recession under their belt and under their reputation, they want to keep the expansion going, right? This has happened in the past. During the Obama administration, you had 6 straight years of no interest rates. It was practically net zero. And this is something we've seen historically throughout centuries. When you have lower interest rates, you have longer expansions in this case. Very similar to what we'll talk about later on in the sense of Ray Dalio, in the sense of his piece on paradigm shifts. But there's this tug of war here where Jay Powell is trying to keep the expansion going as well, but he doesn't believe we need to cut rates anymore. He doesn't want to cut rates. So Trump slammed more tariffs on the China trade war. He used this as an opportunity to propagate not only the Fed to cut rates to continue the expansion, but along with that, to get what he wants out of the China trade war, to start, again, continuing to build up tensions and eventually bring them to the negotiation table. So it's very interesting. But this right here is that tug of war I'm talking about. Trump wants more rate cuts. Jay Powell doesn't want to let up. So this is what Warren and many other investors are worried about right now. Is it going to be that the Fed is going to cut more rates and let us continue the expansion towards NASDAQ 10,000? Right, we're currently at 8,000 right now. It's something I've been looking for in the sense of a possible top. Or have we set the final top of the market? Is it that we're going to see continued increases on the trade war right now? We're going to see the Fed staying hawkish and saying, nope, we're not cutting rates anymore. In fact, we're looking to raise rates over the next few years. If that's the case, then that's going to be a huge hinder on equity markets. That would turn pretty much Warren Buffett and anyone away from buying equities at the moment, right? And it's crazy to think about, guys, but this is just one reason to be fearful of U.S. equities, this combination of interest rates and tariffs. What we really should be worried about is a variety of other problems. The broader fact that we are in one of the longest economic expansions in history, the fact that the housing market in a variety of cities across the world, trillions of dollars of properties are overinflated from foreign buyers, and now that liquidity is drying up. We've got as well the fact that quantitative easing has turned into quantitative tightening. We have been reducing the amount of assets owned on not only the Federal Reserve's balance sheet, but a variety of central banks across the world. And Ray Dalio does a great piece, guys. I will not be able to do it justice because, as you can see, it is very lengthy. But he's got some great charts. He's got some great points to make in this article. And I recommend, I'll leave it linked down below. I recommend you guys give this a read. It came back out in mid-July this year. And Ray Dalio has such a great way of just summarizing the current state of where we are, taking a look back at years and years of history, and being the billionaire that he is, to share this kind of information, to share his perspective like this and the data that they have access to at Bridgewater Capital. I mean, it's just absolutely incredible. So I recommend you guys take it. It's an absolute treat. And whether or not you agree with all of what he says, I think he hits the nail on the head for like 80 to 90% of what's going on. He even talks about some of the underlying economy, but this is something as well that I think Ray and many other people have hit on, and we've talked about here on the channel a lot. The $13 trillion negative yield, the negative yielding bond crisis that is continuing to build up and shows no signs of stopping. So when we're considering all of these kind of ticking time bombs right now, equities don't look very good. Now, technically, bonds aren't equities in this case, to make that very clear. But this kind of shock, if we have a shock and distrust in debt markets, that hurts the entire corporate and economic environment, right? Everything's interconnected in that case. So this is where people might be looking for an alternative hedge, or they're looking to just simply hold cash. Cash can sometimes be king. And this is why, for example, I'm not going long on equities until we get a 40 or 50% correction. Sure, for example, you could talk about how maybe I've missed out on some gains here, but I've had my money exposed in other markets, and even through a 80% correction in crypto markets, I'm still doing better. I'm still doing better than being exposed in equities. And I'm happy that I've been sticking with my guns in the sense of believing that this is a time for hedging. This is a time to start betting on things that are risk averse, or at least are hedges against riskier assets. And that's gold, that's silver, it's cryptocurrencies like Bitcoin, Ethereum, and all kinds of others. And again, I'm still in the belief that we are just at the beginning of this kind of cusp of getting people out of the riskier assets that have been really propped up over the last few years. And when it comes to time, the cryptocurrencies, gold and silver, all these things are overextended, and equities are on the other counter end and they're lower, I'm going to flip the coin. I'll be happy to go long on equities. I'll be happy to consider, maybe buying my first property. I don't know. I'm not looking to buy a property now. They're too expensive. But, again, that's the kind of mindset, guys. You got to be a contrarian in that sense, but also not just be a contrarian during the middle of a trend. Wait for the shift to start to occur. And we have started to see that. If this volatility isn't telling enough, guys, I think we're not listening hard enough in that case. And if we're not listening to the fundamentals at a time where the market is starting to react to those fundamentals, we might end up being on the losing side of the trade. All right, anyways, guys, I rambled on enough for today. Thought I'd do a little bit of a macro video here for Sunday, keep things relatively short and simple, but just felt like putting this out, talking about it, answering some questions. In summary, to answer those three questions we talked about, am I holding any equities? No. At the moment, what's my current outlook on markets? I'm bearish. And the reason I'm bearish right now is simply due to the fact that at the moment, there is not enough elements to provide buy-side pressure to equities. It's as simple as that. Markets are a game of inflows and outflows. If you don't have enough inflows coming in, prices will drop. If enough people are selling, if you have too many outflows, you're going to have prices drop. That's every market. Some people say that makes it a Ponzi scheme. That doesn't make it a Ponzi scheme. It's just markets. It's the same as cryptocurrencies. It's the same as gold and silver. It's buying and selling, demand and supply in this case. All right. So anyways, guys, have a great weekend. Enjoy your Sunday wherever you are. And until the next video, I will see you guys in the next video. Stay tuned.